Hello and welcome, everybody. Happy Friday. Welcome to the end of another week. The start of a bull market for some specific indices, we'll talk more about that later, and another Sectors Made Simple webinar. I'm very happy to be here with you all today to talk about some very positive news that we've had in the market. Now, this week we've gotten a lot of announcements, many of them being earnings, most of them being positive earnings, but also we've gotten some additional economic data to support the idea that the worst is behind us and we're on the road to recovery. Again, nothing is ever for certain, but one thing that we can do is look at how all of these events are shaping the market. And what better way to do that than going to some major indices? Not looking at one or two companies, but instead looking at broad indexes, large groups of companies, many of which you've probably heard of, and maybe some that you might not have. So today I want to take a look at one of these lesser known indices that offers a lot of opportunities for investors, especially in times like this where we might be seeing the signs of bull markets to come. This is one index that serves to benefit from that greatly. So that's the topic that I have planned for you all today. Hopefully you all are ready, have some water and a snack alongside you, and are ready to learn something new. So let's get straight into the action. I actually don't need to go over to the other screen. I just want to make sure before I get too far into this, is the connection looking pretty good? It's all smooth, it's all good to go? Just want to make sure that the internet is happy before we get too far into this. Yes? Awesome. Also, Blaze, is that Gone in your profile picture? It very much looks like Gone. Anyway, this is what I have planned for you all today. We're going to talk about market capitalization and how we can apply that new information with an index called the Russell 2000. Disclaimer, today's is pretty valid. I'm going to talk quite a bit about returns of specific indices, and we're going to go look over some historical charts to put these cherry-picked snippets or segments of data into full context. I really want to give you a well-rounded picture of this, not just one or two charts that some analytical articles pointed out. So with this, I've done my best to provide a very well-rounded and unbiased look at the market, but mistakes can occur, and nothing that I say should be taken as financial advice. Everything I say now is mentioned as a way of educating. It's a way of sharing lessons that I've learned and things that I've found with all of you. And again, past results can never guarantee future performance. Every market is different, so always do your own research. Trust but verify before making any investment decisions. Alrighty, so the context for today's webinar. Before we get into the goal for today's webinar, we need to talk about the context first. Why is this topic important? First and foremost, we've seen a pretty large shift in the stock market. We're finding that as Q2 data comes out in the form of GDP, and also in the form of quarterly earnings, that the thunderstorms that we saw off in the distance of this recession are turning out to be either much more mild than we were expecting, or are showing signs of growth in the form of many companies having very positive earnings. That is in stark contrast to what many investors were feeling of we're entering a recession. This week, we also got July's inflation numbers, showing that we also got unemployment numbers from the BLS, showing that unemployment has gone down in July. Also, inflation has started to go down, stopping at that 9.1% number that we had from June, going now down to about 8.5%. I believe it's 8.4%. It's still very high, don't get me wrong. This is not some cause for celebration, but a reversal is very welcomed. We need this reversal as inflation is part of the reason that recessions happen. It's an increasing cost of everything that wage can't keep up with. So if inflation starts to dip down, that is a very positive indicator for the economy that what we've already experienced might be the bottom and that we're starting to see signs of that early recovery. Looking more at the stock market and companies, we've found that this earnings season has been well above averages. We've found that companies that have beat earnings estimates have seen over 3 times larger gains than previous years, as well as we've seen that companies that missed earnings estimates still held true, where the average return for companies in the S&P 500 that posted earnings under estimates, 0%. So we're finding that the market is not punishing bad news and is celebrating good news like it's everyone's favorite quinceañera. It's huge. So this has been a very monumental earnings season, given everything going on in the economy. Now, I'm talking a little bit here about the economy. I want to focus instead on the stock market. And I want to look at the state of the stock market in the context of where we are today. So the state of the stock market is, as I see it, this. The first half of 2022 was disastrous for many, and by many I mean most indices. Long investments fell short, and we saw many companies drop in quarter one earnings, but also in price. Companies such as Amazon dropping multiple percents. We're talking, 30, 40%. Netflix down 30 to 40%. Facebook, or Meta, joining them. If we look instead of companies at broad indexes, we found that the NASDAQ, which we'll represent as the QQQ, lost 32.4% of its value from its year beginning point. And this is, by the way, the market bottom. All of these market bottoms occurred in the middle of June, about June 15th to 16th is when we saw all of these different indices bottom out. So whenever I'm showing these numbers, it's showing from their highest point, which for most was either in mid-November or in late December, early January, down to their bottom, or the trough, in mid-June. Oh, Erica's going on vacation. Awesome. Enjoy your vacation, Erica. So let's look at some returns between that period, that market top to market trough that we've observed. For the NASDAQ, it was 32.4%. For the S&P 500, it was negative 23.4%. For the Dow Jones Industrial Average, it was negative 18.8%. Oh, you were on vacation. I hope you had a great time. Where'd you go? But these are 3 of the major indices that you probably know, think of, and see on any major news network that's reporting on the stock market. There's one that many investors overlook, and there are reasons to why they overlook them, and we'll talk about that in a couple minutes. But I want to highlight that, and that this specific index is what we're going to talk about in detail today. The Russell 2000. Now, the Russell 2000 we're not talking about because it's the resilient index that beat the bear market, held steady, and returned positive results, or just held true through a bear market. Not exactly. The Russell, in fact, had the largest drop of any of the 4 indexes that we've talked about so far, just inching out above the NASDAQ, or I guess below the NASDAQ, at 32.5% down. Now, I've told you Russell 2000, but I haven't explained what it is. So before we get too far into all of this presentation, let's take 2 steps back and let's go talk about what the Russell 2000 actually is. And before we do that, we need to talk about one thing in particular: market cap. Market cap, or market capitalization, is a way of explaining how large a company is. Now, you're probably thinking, well, there's a bunch of other things we can look at. We can look at earnings, we can look at how many employees they have, how much revenue they generate. But none of those are truly accurate. In fact, Tesla was an incredibly valuable company well before they were turning a profit. In fact, they didn't turn a profit until the late 2010s. I believe it was 2018 was the first year that Tesla posted positive earnings for a quarter, because every dollar that came in was immediately thrown back into the company to invest in research and development and production lines. So when you're seeing earnings, it doesn't tell the whole story. Very large companies will have negative earnings, but that doesn't mean that they're not large companies. It means that they had challenges or large investments that they were putting back into the company. So we need a different way. And what better way than to figure out the value of a company than to ask the stock market? Hey, you, Juan de los Palotes, what do you think Tesla is worth? Well, they're not going to go ahead and try and guess what all of Tesla is worth. Instead, they're just going to say what they think one company is worth. Or what, not one company, I guess that's true, but one share of that company is worth. So you might say, there's 1 billion shares of Tesla. What do you think one share is worth? And they are going to tell you what they think it's worth. That one share is the value that the market is willing to place on that company. And market capitalization takes advantage of that. So market cap for a company is as simple as finding the share price and multiplying the share price by the number of outstanding shares. So if we wanted to, we could go to something like Finviz. We can look up Tesla. We can find their number of shares outstanding. Also, for the record, I threw this number out as an example. I didn't think it was literally exactly 1 billion. But it's 1 billion. All right, we can go with that. It makes math easy. All right? And each share is worth $900. Oh, wow, they're really making the math easy. So what's the market cap of Tesla? 900 per share times 1 billion shares outstanding. $900 billion. Small evaluation. So that's as simple as it is. That's how easy it is to calculate market cap. Shares outstanding times the price of each share. And the reason we do this is, one, it's a great way of looking at companies of all different shapes and sizes, quite literally different shapes and sizes. But we also use it for a number of value-based purposes. That being, when we want to figure out who matters more in the market, Tesla or Amgen, or Tesla compared to Staple. Don't think Staples is publicly traded. Let's go with Target. Better example. What 1% that Tesla does is a lot more important than 1% of what Target does. So it's important for us to know the difference in size between companies. So we can use market cap for that. But there's other things that we use it for. And let's go to probably the biggest example that some of you might be thinking about, and if you're not thinking about it, you're about to, the S&P. Many major indices, with a few minor exceptions, are market capitalization weighted, meaning the more market cap a company has, then the more value that company's earning, or that company's profits, rises in stock price really, have on that index. So Tesla is going to have a lot larger of an impact for the S&P 500's value than the smallest company in the S&P. But we can also use it to group companies. And that's what I want us to focus on today. We can group companies based on their market capitalization. Here are the three major groups that we have. So the first one is large cap. Large cap tend to be companies that are $10 billion in market cap or more. How do we determine if a company is overvalued? Amazing question, Eddie. Let me finish up with this slide and then I want to talk about that because that is a really, really good question that I don't think we'll really cover today. So I do want to answer that. Great question. So we have large cap. The second thing we have is mid cap. Mid cap is going to be companies that are 2 to 10 billion in size most of the time. When I say most of the time, the reason I say that is there are exceptions, and we'll talk about a few of those exceptions when we get to our good buddy Russell over here. There's not anyone actually here, but pretend that Russell is right over there. But then, finally, let me see if I can get... I had to get a little creative with the green screen today, so... Anyway, the last thing we have is small cap companies. Small cap companies range anywhere between 300 million and $2 billion market cap. Again, most of the time. So now, I ask you. And I'm going to ask this question, then I'm going to answer Eddie's question while you all are responding to this. Audience participation time. And then we'll get into the answer to this question. Because there is a right-ish answer to this one. Ultimately, there is never a right or wrong answer for investing. It's all what works best for you. But as a general question, is bigger market cap always better? Now, Eddie, you brought up a great question. How do we determine if a company is overvalued? Well, there's two parts of this. The first is, what is the value to you? If you look at a stock's price in the stock market, that is the price that the market deems that stock to be worth. It is not the price set by the company. The price set by the company was set a while ago when they IPO'd. So it's the value that investors, the collective investment community, feels that it's worth. That value is based on a number of things. Present value, which is anything from earnings, profitability, key factors that make it a strong competitor, core competencies, things that they do that others can't. Many of those things will go into its current value. The tech that they have right now, that is current value. But there's also a component of future value. It's this idea that the company's worth something today, but they could be worth something tomorrow. And that's where a lot of the value of Tesla used to be. It wasn't in that they were profitable today, they're making money today. No. It's that they are selling cars today, but their goal is to be profitable in the future. And not just a little profitable, a lot of profitable. So that's the theoretical answer, is the price that we see in the market is supposedly supposed to be the fair price. Anytime we get new information that would change what people think it's worth, earnings, it changes that. And we'll see that happen, where if you want to study point and figure charts and see this in action, a bullish triangle, or any triangle forming, is the result of a change in value. The market feels that the price has changed. Let's say the price went up. So the price is going to shoot up. Actually, let me see if I can find a quick chart to show this. Sorry, everyone, we're going to go on a little bit of a detour. This is a great question that I really would love to answer. Perfect. This is Netflix's chart. And we're going to go back in time a little bit to right in this area. What we see is what happens when the market feels that the value of something isn't correct. So if we look here at where the 5 is, the price goes down, back up, and then tanks. Drops from around $200 to $164. The market felt that $200 way too high, so they corrected it. But what very often and almost always happens with corrections is they go too far. The value of Netflix wasn't really $164, but a bunch of investors saw the price tanking, their trailing stops hit and they got out, or their panic hit and they got out. So the price always falls too much. Then the price goes back up because people felt that it was sold off too much, so it goes back up, back down, back up, back down. That triangle is quite literally the market trying to figure out what the new, current, proper value is. So at any point here, you could have said 164, that's undervalued. 194, that's overvalued. And as the market comes closer and closer to a consensus, to an agreement of what it's worth, the margins get narrower and narrower, and a buy signal or sell signal occurs when we have a breakout of that triangle, because that means something new has happened. Something's different. Because the market knew what they thought the price was going to be. The market thought the price is going to be somewhere between $192 and $180. And then all of a sudden, they felt it was worth $200, and the price went back up. That's the long answer. The short answer, if you want to just do it quick and dirty, super easy, compare the price to the sector. Price to earnings is a really great idea for finding that answer. Compare the earnings of a company. So if we go to like FinViz, this is just going to show you how undervalued or overvalued it is compared to the sector. But we can go here and we can find the price to earnings ratio, $108.04 for Tesla. If we go to consumer cyclical and close this ad, what we can find is if we go to groups, valuation, we'll find here that under consumer cyclical, the P/E for consumer cyclical is 25. So one very simple, quick and dirty way of checking if something's overvalued or undervalued is looking at P/E, comparing the P/E of a company to its sector. Keep in mind when you're doing that though, a company with a P/E higher than the sector is not a bad company. It doesn't mean that it's overvalued or undervalued. It just means you're paying more for less earnings. But sometimes we're okay with that if it means we get a stronger company. Also, my mom is saying that Morningstar has a measurement for fair value. Also really good to know, and one that I want to explore in the near future. Maybe a topic for a future webinar there. So let's get back to our regularly scheduled programming here and answer this question. Is bigger market cap always better? No, not always. Because the answer is it really depends on what you're looking for. There are values for both large cap and small cap companies. But to talk about which ones are better in different scenarios, let's talk about the differences first. So first, let's start off with large cap companies. These are going to be the ones you're probably most familiar with. These are really well established companies. They are the adults. They are the big kids big kids at the table. They're the big guys. They're the big fish in the pond. They're oftentimes leaders in their sectors and industries. These are, again, $10 billion plus companies. They also tend to be less volatile because they are so well established. They're not affected by little changes in the economy. They are big, their momentum is moving in one direction, and it's pretty hard to stop that momentum. And in addition, because they are well established, they very often will have recurring dividend programs for their investors, providing consistent, recurring, but also oftentimes increasing dividend yields. Now, these companies also tend to be what we can call value companies. Not always, but many of them are considered to be value companies, where the price of the stock is not based on future value like we talked about before with when Tesla first appeared in the market. Its value is based on what it does today, not what it's thinking about doing tomorrow. According to a study done in 2019, 87% of public companies are large cap companies. Let's skip over mid cap really quick, and let's go and talk about small cap companies. Small cap companies tend to be growth oriented, meaning that their value is based on their future value. It's the idea that they're worth something today, but they're probably going to be worth something more tomorrow. And you're not paying what they're worth today, you're paying something in between what they're worth today and what they could be worth tomorrow. Now, these companies typically are higher risk. They oftentimes have much higher betas or volatility compared to the market, and are higher risk due to their small company size. But with this increased risk, oftentimes comes greater room for reward. It is very possible that the price of a small cap company doubles in a year. Anytime someone says, well, you could have invested in Amazon when it was a $50 company, they're right. At a certain point in history, Amazon was a growth company, a small cap company growing its way to being one of the largest e-tailers in the world, the largest e-tailer in the world. But not every company is going to become Amazon. Many companies and most companies won't. So there is increased risk. And part of that risk is the fact that they're more sensitive to small changes or even large changes in the economy. As far as market cap is concerned, 3% of companies are small cap companies, which then brings us to mid caps. For mid cap companies, we're looking at something in between the two. And again, doesn't mean that all large cap companies are value companies. It doesn't mean all small cap companies are growth companies. It just means that those are what they tend to be. The majority of them are. Mid-cap is, imagine you took a blue paint bucket and a red paint bucket and threw them on the ground. You have a giant splattering of purple. That's mid-cap. These are a blend of growth and value companies with absolute crazy variance in how long they've been around. Many companies are well established, but due to a smaller industry, are mid-cap companies. Other companies are brand new, but because of their industry, are still mid-cap companies, doing billions of dollars in revenue a year. About 9% of companies fall into this mid-cap category. So, now we've covered what mid-cap, small cap, and market cap really is. Let's get into the topic now of good old Russell and the year 2000. Not year 2000, but let's go talk about Russell and his 2000s. The Russell 2000 is not a person, instead it's a stock index managed by the London group FTSE Russell. Now, the Russell is a stock index that is market cap weighted based on 2,000 small cap companies from the US stock market. Now, here's something interesting for you all. Remember before, we said small cap companies tend to be in that, $300 million to $2 billion range. The average, now let's find the average. If you're just thinking about the math of it, you're going to think, all right, well, 300 2 billion, which is 2,000, somewhere in the middle of that, right? Not exactly. So the Russell 2000, the average value of a company in the Russell 2000, 3.17 billion. What? I thought we said before it's 300 to 2 billion. It is. But the Russell 2000 is only readjusted once a year. So if a company is on the edge of that $2 billion line, gets grouped back into the Russell, or even some companies, like I said before, market cap is more than just a single number. Very often, there are a few other considerations that they make. It's going to be small. The biggest part is, yes, their market cap. But a mid-cap company could be slightly under 2 billion, just like a small-cap company could be slightly over. But if a company grows after the adjustments for the Russell 2000 are made, they grow past that $2 billion mark, they're still in the Russell 2000, but their value is significantly higher than all of the other people, bringing that average way up. If we looked instead of the average, we looked at the median, which means you take the biggest and smallest, get rid of them. Next biggest, next smallest, got rid of them. Go all the way down into a single thing. That middle number does fall within that range at 0.93 billion. Ooh, Kike. Jonathan, will you break down large, mid, and small cap stocks into SMS matrices? Great question. Can we do matrices for it? It's going to be tough because, again, the reason that we look at S&P 500 sectors is it's easy for us to make a matrix of 12 securities, in this case ETFs, because we don't need to look, we only need to make 132 charts. If we wanted to do a matrix of the Russell 2000, it would be 4 million minus 2,000. It's going to be easier to say that than actually list out the number. But it's going to be about 4 million charts per day to calculate the Russell 2000. So it's really difficult to make a matrix that big. But one thing I would love to do, and something that we'll likely see as we start to get more and more into research with sectors made simple data, is there are no BPIs that I've been able to find for the Russell 2000. So we definitely will be working on a Russell 2000 BPI so that we have that information. So if that's something that's interesting to you, stay tuned. We'll have more on that in the very near future. But as far as making a matrix of 2,000 securities, that's pretty big. It could be done. That might be something we do on a yearly basis or something like that. But we can go from there. ETFs of the S&P 600, 400, and SPY. Yeah, we could definitely do that. Yeah, anything smaller like that that's somewhere under 100,000 charts, we could probably realistically do. But again, we have some really cool stuff planned for you all in the fall. Nate has been working on a lot of really cool stuff behind the scenes to make running matrices faster, but also let us test strategies and find more interesting data for you all a lot easier. So we're really happy to get to have that system set up so we can bring you all creative and also unique data as it becomes available to us. So again, if you're a Sectors Made Simple subscriber, stay tuned. We have a lot of really cool things in the works for you all. If you're not a subscriber of our YouTube channel or Sectors Made Simple, for YouTube, hit the subscribe button. It's totally free, and we greatly appreciate it. If you're not a Sectors Made Simple subscriber, consider subscribing. We have lots of great market analysis tools, simple strategies to help you get started with our data, and over 100 hours of additional educational content, much like the webinar you're watching right now. Let's get back to Russell 2000, because there's version 2.0. Well, not version 2.0. There's a different Russell index that I quickly want to mention, just in case it's something that's burning a hole in the back of your head, I do want to mention it. The Russell 3000. We're not going to get too far into the Russell 3000 today, but I want you to be aware of it. It is an index of 3,000 companies, where it includes the 2,000 small cap companies from the Russell 2000 plus 1,000 large cap companies thrown in for the mix. This covers about 97% of the market cap of the US stock market. So the Russell 3000 is a crazy comprehensive look at the entire stock market. Not just big, not just small, a good blend of the two. If you're a mid-cap company, sorry, you kind of get left out. It's okay. But why should I care? Why have we talked now for 35 minutes about some small cap index if it barely moves the needle as far as market cap is concerned of the overall US market? Well, before I can answer that, I first need to tell you a little bit more about why small cap companies are so important in the stock market and why we are giving it the limelight in today's webinar. These companies, as I mentioned before, tend to be much more sensitive, much more volatile compared to the market, especially when there's changes in market atmosphere, bull markets versus bear markets, and economies, where they'll perform differently in a recession compared to a recovery. To give it a great example, think about this on a local level. In a recession or economic downturn, you won't really see the Domino's or the Subways in your communities closing. They have a lot of money that they can keep their businesses afloat through those economic hard times. Unfortunately, the areas that you see or the shops that you see closing during these economic downturns are the mom and pop stores. It's the family-owned restaurants or stores that can't weather months of economic downturn. They rely on that constant business, and the minute that business stops coming in and they're not able to make as much profit, they have to close. That is true for public companies too. These small cap companies are the mom and pop and family stores of the stock market. So when a bear market hits, these are the guys that get hit the hardest. And they also are the first to get hit. Let's go and look at some numbers. Below, what we have is a comparison between the S&P 500 and the Russell 2000 between November of 2021 and early June of 2022. What we see here, in and out, that does sound good. What we see here is in purple, we have the Russell 2000, and in orange, the S&P 500. We see over this period that the S&P 500 dropped about 12.3%, and in that same period, the Russell 2000 dropped by 22.9%, almost double the losses of the S&P 500. But while we're here, I do want you to notice something. Look at all of the individual peaks and troughs and when those are happening. We see that the drops are observed in both groups. We find that the peaks are observed in most groups. These two lines follow each other very, very, very closely in terms of the ups and downs. But one thing is true across most of this entire chart. When there are changes, the Russell is seeing larger changes. They're both seeing ups and downs, but the ups are bigger, the downs are bigger. But in cases like this, when it's mostly downs, those bigger downs are going to emphasize and attenuate in the Russell 2000 with those small cap companies. Oh, JP, I'm so glad you guys enjoyed the Figuring Out Finance classes. Those were so fun. And if they have questions, again, please, they can always email us. So let's break this chart down in a little bit more detail. What it's showing us is that the overall trends of the S&P 500 and the Russell 2000 are almost identical. Days that are positive for the market, we're seeing rises in price. When we see downtrends, the losses for the Russell 2000 were larger than the S&P 500. So why, in 2022, in the middle of a bear market, are we talking about the Russell 2000 if it underperforms compared to the S&P 500? Well, because while small cap companies do underperform in bear markets, because they're usually the hardest hit, they're also the first to recover. And when they recover, experience stronger recoveries than large cap companies. Let's go and take a look at another chart, shall we? So, right here is another chart. This chart is not looking at the past 2 months of data. We'll look at that on our own. Unfortunately, I didn't find any charts for that, and I'd rather go do that live with you all. But one of the charts that I did find was this one that shows us what happened in the post-COVID market. So this chart begins back in the spring of 2020 and leads us up through just coming up to July of 2022. What we find is that when the market began to recover, the Russell 2000 exploded compared to the S&P 500. Where the S&P 500, when it was returning just around, let's go right here, let's say around 65%, the Russell was almost double that. So what we're seeing is the Russell recovered really quickly. And the reason that we only see 90% compared to 72% here is that this is already including that downturn, where again, the Russell is historically more volatile. We find that it rose faster, but it also falls faster. So at its peak, the Russell from its recovery at the end of the COVID bear market went up almost 150% return. And then at the same time, that's over 50% more than the S&P returned in that same period. This is a question that randomly came to mind. If a new company is added to a stock index, is one added and another removed? For example, if a company wants to join SPX, would one of the 500 be removed? Yes. So, great question, and I'll answer it very quickly. And if you want more detail, let me know. The S&P 500 is made by a committee. There is a group of people that decide the 500 companies within the S&P 500. If they want to add a new one in, another one gets removed. So that's the S&P. It is a group of people that decide what the 500 companies in the S&P 500 are. For the Russell 2000 and the Russell 3000, they go basically by the book. They go by the math. So they'll take 2,000 companies that are small cap, 1,000 companies that are large cap, and that's it. It is math. It is not opinions. So that's the main difference between the two. The S&P is a committee deciding what companies make it. For the Russell, it is determined by a computer. So again, what we've seen now is that the Russell falls faster than the S&P, but also recovers faster than the S&P. I want to now go and look at the data with you all for 2022. And again, I want this to be a very honest look, so I'm going to start from scratch here, and we're going to go and step through this together. We're going to go to a PerfChart here, and for the Russell 2000, we're going to use IWM. Come back. And we're going to use good old SPY for the S&P 500. I need to get an ad blocker. All right. So what we see here is we see the Russell 2000 compared to SPY. And I'm going to narrow this down so that we're looking at, again, the market bottom here was June 15th. I went too far. There we go. This is the recovery that we've seen so far in 2022 from the market bottom, with both securities starting at 0%. We've seen the S&P 500 return 16.74%. The Russell 2000 has returned 21.3%, almost 25% higher returns than the S&P 500, which again still is not done poorly. The S&P 500 is done really well. These are not inverse. One does not go up when the other goes down. Instead, both go up, but one is more volatile than the other. If we extend this back, we can see this trend occurring. Let's go back to 2020. We're going to go back and find market bottom, which was there. And we see that recovery in full detail, where if we end this before the market starts to reverse in 2022, so that should take us up to the end of November. November is where the market started to really turn around. So if we looked at it here, what we would see is as things began to recover, the jumps and the drops are still the same, but the Russell's returns are significantly larger than those of the S&P 500. Now, humor me, let's go and add the Russell 3000. And what you'll notice is if we're in a perfect world here, which we're not, so we'll see what happens, we should expect to see the S&P, which is large cap companies, the Russell somewhere in the middle, because it's a composite of both large and small cap, and we should see Russell at the top or the bottom. So we should always see, again, in a perfect world, and the world is not perfect, we should see SPY on the top or bottom, 3000 in the middle, and the 2000 on the top or bottom. Let's step back now to 2020 at the market bottom here. And we see something very, very similar. We see the Russell 2000 leading, the Russell 3000 sandwiched in the middle, and the S&P 500 completing the sandwich on the bottom. So what did we learn from these charts? What we learned is that what we found in the Y charts, those two charts that we saw in the presentation, do hold true in 2020 and 2022. What we're finding is that during market declines in both years, the Russell 2000 experienced larger losses than the S&P 500. But also, once a bottom was hit, which happened simultaneously, or I think one day apart, for both indices, the Russell was the quickest and first to recover. Before we get to any conclusions, I want to go back to that chart one more time, and I want to add the NASDAQ, just for a little bit of spice. We're going to get a little spicy here. We're going to get rid of the Russell 3000, and instead, we're going to add the NASDAQ in the form of the QQQ. No, go away, please. Thank you. All right, let's go back to our June example and see what we find. What we find is that the NASDAQ and the Russell 2000 did pretty similarly. They performed both very, very well. If we look back in time, let's go back to April. And let's cut this down. Again, what we're finding is the NASDAQ performs very well compared to the S&P 500 in this case. But once again, the Russell 2000 seems to be the clear leader when the market is in a bull market. None of these are inverse. These are all very, very, very long securities. These profit when the market goes up. But the Russell is the most sensitive of the three. And also, when the market begins to recover, offers the most opportunity for investors. So before we end today, I feel like there's one question that we should answer. For how long are we going to see the Russell 2000 outperform the S&P 500? Well, unfortunately, there is no easy answer to that question because you never know where the bottom of a market is until you hit it. You never know where the top of a market is until you hit it. And by that point, you're already going back down. So all I can do is give you my opinion. In my opinion, the Russell 2000 will likely continue to outpace the returns of the S&P 500 until there is another shift in market atmosphere, being a bear market or a full-on recession that causes a reversal in the market once again. One easy-ish way to track this change is we can go to stock charts and we can make a relative strength chart. And we can follow SPY versus IWM. Come on. Please give me a point and figure chart. So we can track this chart, which will be able to give us an indication of the relative strength between SPY, an S&P 500 ETF, and IWM, a Russell 2000 ETF, where we have our long-term and our short-term indicators to show strength. Our long-term indicator is going to be that breakout or breakdown, or the trend, depending on which one you prefer. Right now, we have a downtrend and a double bottom breakdown, indicating that the Russell 2000 is holding long-term strength over SPY. For short-term, we have the direction of the current column, again, being negative, implying that the Russell 2000 is currently stronger than the S&P 500. So now, one last question that we should answer, because again, I want to tie this all back into why should I care and how do I use this information? How can you invest in the in the Russell 2000? Like many major indices, the easiest way is probably going to be ETFs. There are mutual funds that offer exposure to the Russell 2000, but there are also ETFs that will make our lives pretty simple. There are many different options for us to choose from. Many of these are non-leveraged and carry expense ratios in the 0.2 to 0.1% range. And there are also leveraged, 3x leveraged, and also 3x inverse leveraged ETFs with, yes, higher expense ratios up to around 1%. So if you're looking to get exposure to the Russell 2000, but you also want to have a little bit of influence from the S&P 500, either as a way of hedging your bets or just diversification in a single ETF, there is the Russell 3000 as well, which includes most, if not all, of the S&P 500 companies and a couple more. Is the recession over with? Great question. The answer is it depends on if you believe that we ever were truly in a full recession to begin with. A recession, again, is not a black and white thing. It's how deep did we go? There was market pullback, there's economic pullback, and if all you looked at was GDP, yes, we're in a recession. But one of the biggest things, in my opinion, to dictate a recession is a spike in unemployment, which we haven't seen. In fact, unemployment has improved and is finally back to pre-COVID levels. So we've seen improvements in unemployment, which is a very positive indicator that if we are in a recession or if we're pulling out of a recession, it was never a severe one to begin with, which is a welcome thought for investors and citizens alike. So let's wrap all this up and see where all of this leaves us. I haven't talked about this, but now is a good time to. The NASDAQ is now back in bull market territory. From its bottom point, in mid-June, we've seen this index rise 21.7%. The S&P 500 is lagging behind, but currently at 16.7% return. And the Russell 2000, the subject of today's presentation, and the small cap market that we would hope would be the first to show signs of recovery in the market, is showing those signs of recovery as well, has entered a bull market, and is up 22.2% in the past 2 months. So where does this leave us? Well, we're seeing that major markets are beginning to emerge once again. And as history has shown, the Russell 2000 is one of those markets that fully takes advantage of recovery periods in the economy. They thrive on that recovery as they're the ones to make or break their success based on the success of the economy as a whole. So if you didn't know what the Russell 2000 was before this presentation, now you do, and now you understand its importance. If you didn't know, or if you did know what it was, hopefully now you have a little bit more context and knowledge about the role that it serves in our portfolios, but more importantly, in our ability to monitor the market and know that there is always a bull market somewhere. Thank you all so much for joining us for today's webinar. I hope you enjoyed this detailed look into an area of the market that is oftentimes overlooked and rarely highlighted. It was a pleasure to get to bring this information to you all. And as a quick announcement, next week, I will not be here. Instead, Julie Stav will be taking my place, running the both members and non-members webinars for you all on Tuesday and Friday, respectively. Those webinars will be done on Zoom, and we'll be sending out a link to those videos that you can get. Not the links to the videos, the links to join those Zoom meetings. If you want to join Friday's meeting and you're not sure where to go, what we will do is we will have if I can open this up, we will have the link to the Zoom on our Facebook. So if you don't have a Sectors Made Simple account and you don't get our emails, you can also find the link to those sessions on our on our Facebook channel, which I am going to try and grab for you all right now. So here is our Facebook if you would like to stay in touch and join next Friday's webinar live. But that's all the time we have for today. Thank you all so much. Have a great weekend. Stay bullish, and we'll see you all very, very soon.